Welcome to tastytrade's Options Strategies series. In this episode, we will cover buying a call option, which is a bullish option strategy. We will start by breaking down the basics of a long call, then I'll follow up with some example scenarios. Finally, we will cover some risks investors should consider when trading long calls. So, what is a long call, and why would an investor choose this strategy? Purchasing calls is an inherently risky option strategy since you can rapidly lose part or all of your investment relatively quickly. However, they do have the potential to yield substantial profits without directly owning the underlying asset. Long calls can provide investors with a less capital-intensive way of gaining bullish exposure to a stock. Since each options contract controls 100 shares of the underlying, the potential to yield large profits quickly can be attractive. But it comes with trade-offs. To better understand those trade-offs, let's break down the basics of a long call. A call option is a contract that gives the owner a right, not an obligation, to buy the underlying stock at a fixed price, known as the strike price, on or before the option's specified expiration date. These types of options are known as American-style options. For example, an investor buys a $100 strike call on XYZ for a price of $2 that expires in 30 days. This gives the investor the right to buy 100 shares of XYZ at $100 per share over the next 30 days in exchange for paying $200. In our example, we are paying $200 because standard options quote in units of 100, which represents the number of shares each contract controls. So you must multiply the quoted price by 100 to determine the cost of the contract. Investors buy call options with the expectation that the price of the underlying asset it tracks rises, ideally well above the option's strike price. Generally, when you buy something, you want to buy it at a low price and sell it at a higher price. Similarly, long call holders want to purchase their calls at a low price and then sell them for a higher price to make a profit. Now, let's cover what makes up the value or premium of a call option. A call option's value or premium derives from its intrinsic and extrinsic value. When a call option strike price is less than the current share price, it has an intrinsic value because it offers the owner the right to buy 100 shares below the current market price, also known as being in the money. In the money options can also have extrinsic value. Many factors can affect an option's extrinsic value, but two common factors are days until expiration and volatility. An option's extrinsic value directly correlates with how many days it has until expiration, also known as time value. Factors like heightened volatility can add to an option's extrinsic value too. Let's look at another example. An investor buys an XYZ $100 strike call for $7 that expires in 30 days. If XYZ is trading at $105, that means that the long call has $5 of intrinsic value per share, which is the difference between the option strike price and the current price of XYZ. The option also has $2 of extrinsic value per share, reflecting the call's time value and other factors. Like all options, it is important to note that over time, the extrinsic value of in-the-money options will decay to zero as it approaches expiration. In our example, if the price of XYZ stayed at $105 through the option's expiration date, the option's extrinsic value would decay and likely trade near $5 or its intrinsic value. Conversely, a call option with a strike price above the current market price can also have value. When a call option has a strike price above the current stock price, it is known as being out of the money. When an option is out of the money and has value, it only has extrinsic value. Investors that buy out of the money call options can potentially yield gains if the underlying approaches or rises above the option's strike price, since it allows the investors to purchase the underlying at a discount when it becomes in the money. Out of the money calls that remain out of the money or in the money calls that become out of the money can decrease a call option's value. At expiration, if the underlying price is less than your call's strike price, the option is worthless because the ability to purchase an underlying at a price higher than what the market currently offers holds no value. In essence, long call holders want the underlying price to increase above their strike price on or before expiration to make a profit on the trade. However, buying options can be an uphill battle since they suffer from time decay, and a call option's value may decrease each day if there are no proportionate increases in the underlying's price or volatility. Now that we've gone over some of the basics, let's dive into some profit and loss scenarios at expiration. If we take a look at the profit and loss graph, long calls have unlimited upside profit potential and a defined max loss, similar to a stock, since the most you can lose is the amount you paid. Let's say, for example, XYZ is currently trading at $100. An investor purchases a $105 strike call option on XYZ stock for a price of $1 that will expire in 45 days. The break-even point at expiration for this position is $106, as the investor would need to realize a $100 profit to offset the call option's cost, not including any commissions and fees. After 45 days, if XYZ increased to $110 at expiration, the call would be in the money, and the long call would automatically be exercised at expiration. Assuming the investor had sufficient account equity to take on the shares, the call would convert to 100 shares of XYZ purchased at $105 per share. Come the next trading session, if XYZ remains at $110, the investor can sell the XYZ shares at $110 and realize a profit of $500 from the sale. However, the $100 paid to purchase the option would offset that for a net gain of $400, excluding commissions and fees. Conversely, if XYZ remained at $100 and below the call option strike price at expiration, let's say at $90, for example, the call option would not auto-exercise since it expired out of the money and worthless, resulting in a max loss of $100. While buying a call option can be a less capital-intensive way to gain long exposure to a stock, there are some risks and other factors to consider. When you buy an option, there's always a risk your option expires out of the money and you lose the entirety of your investment. There's also the risk that your long call is exercised at expiration, resulting in the purchase of 100 shares of the underlying, even if you don't have enough cash in your account to cover the margin requirements. There is always an option to submit a do not exercise or DNE request to avoid your in-the-money calls getting automatically exercised. DNE requests only apply to long options, and investors will forfeit the option's value by submitting one. Generally, options traders who do not want the underlying asset seek to close, or in this case, sell their calls before expiration, before the option could potentially be exercised. Lastly, factors like theta or time decay negatively impact the value of an option and is not beneficial for long option holders. Theta decay becomes exponential as an option approaches expiration. Hence, The longer you hold a long option, the more susceptible it is to time decay. Also, contractions in volatility, or how quickly an underlying's price fluctuates, can decrease an option's value. Successful long call trading requires a correct directional assumption and quick price movements to compensate for lost time value and potentially yield a profit. In any case, purchasing calls can be a capital efficient way to get bullish exposure to an underlying while capping your mass loss potential. Looking to open a long call on the desktop platform? Check out our tutorial videos here.